Hello everybody, welcome to another one of my investing videos. My name is Mark, and in this video I made some money. So let's go ahead and jump right into it, and let's take a look at the transactions. So here's my transactions right here, and this all started on June the 4th, about a month ago. And today is July the 3rd, 2019, and right there, as you can see, I bought 200 shares of Steel at $13.14 for a total investment of $2,634.95. And then I simultaneously sold to open two call options, that's covered calls, because whenever you sell to open calls on a stock that you own, that's known as a covered call. And the reason why we call it a covered call is because if the price of the stock goes higher than the strike price of the call, then the stock that you own covers all the losses that you take on the call option itself. So that's what I did. I sold to open two call options, strike price $13.50 for the premium of $33 a contract, expiration on June 14, 2019. So that would have been about a 10-day window when they expired from the time of the transaction, and took in $64.47. And if we go from right here and you add up all the green numbers and add up all the red numbers, and we go down to here, it would have been on June the 26th that I got out of this trade. It's about a week ago. I'm a little slow making this video. I was having some computer problems, but here I am. And so from where this blue starts and to the end, if you add up all of the green numbers and all the red numbers, and then you take the red total and subtract it from the green total, then you will see that I made $182.95, and that's the money that I made on this $2,634.95 investment. And just for kicks, let's see what the rate of return is on that. So what we do is we take $182.95 and divide that by, and I got my calculator right here, 2634.95, and my calculator says I made a 6.9% return on that trade. Now, I'll just say with all due respect that I don't believe rate of return matters. To me, what matters is the dollars that you made. And I made $182.95. That's what really matters, because let's say that you make $10, on a $20 investment. Well, are you going to brag and say I made a 50% return? Because you made $10. I mean, whoop-de-doo. And, $6 or $7 goes bye-bye to commission. So to me, rate of return doesn't matter, but it's good just to kind of get your warm fuzzies to say, look at me, I made 6.9%. But what I really look at is the dollars. I made $182.95, adding up all the green and adding up all the red. And so I bought 200 shares and I sold two covered calls. Now, the way the covered call strategy works is that it's just like anything else. It has a risk and it has a reward. Now, the risk is this money right here minus this money. So obviously, I don't want Steel to go to zero. If I thought that U.S. Steel was going to go bankrupt, I wouldn't do it. And actually, I'll just tell you the reason why I bought the 200 shares, and it was on June the 4th. If we take a look at my chart here, this is a 3-month chart. And if we pull up the drawing tool, June the 4th is right about there, okay? And when this happened and Steel finally made a big move like that, it finally made its first big move. I mean, it did make one big move, but Steel's pretty much been doing nothing but going down. And I've just been waiting and waiting and waiting. I have another 200 shares, which I'm still holding at this moment, but on those 200 shares, I'm doing an option collar. And I'm still in the red on that, but I'm still in the trade, and I have put options that are hedging me. And so I'm down about $300, which is pretty good because dollar cost average, I bought those 200 shares way up here at like $20.66. Steel right now is at $14.68, and so that's about $6 a share. And so instead of being down $1,200, I'm down $300. And so, but that's a whole nother video on option collar, and that's also a whole nother trade that I'm doing. Okay, this trade, the covered call trade, which I'm doing the video now, I bought those 200 shares because I felt that steel kind of bottomed out, and it has, you know. Now, do I think that steel will go back down here? Yes, I do. I think it could. Do I think it's going to go lower than this? No, I don't. If I did, I wouldn't have bought those 200 shares, and I wouldn't be doing the covered call strategy. So back to my account here. So one of the things I want to say about the covered call strategy is that the covered call strategy is good on a stock that you think is going to go up, or maybe it might go down, but it's not going to go down a lot. Okay, so it's good on a stock like that you think is going to go up. Now, if steel, let's say steel goes way up to $50 a share, I'll still make the same $182.95 a share. Now, I will probably say to myself, doggone it, man, I wish I didn't sell to open those 1350s, because I'd make a heck of a lot more money. But you will still make money on a stock that you sell to open covered calls on. Now, the idea of the covered call strategy is that when you sell covered call strategies on the stock that you own, you want the stock to go up. And if it goes higher than the strike price of the call, that's the best possible scenario. Okay, one of the things that beginning option traders get it wrong is they'll sell covered calls on a stock and they don't want the stock to go up. They want it to go down because they think they're going to make an income. But the covered call strategy is not an income strategy. And there is about 1 million videos out there that will tell you otherwise. And in my opinion, they are all of them are misleading. Okay, the covered call strategy is a hedge. Okay, that's the proper way of thinking about a covered call strategy. And the reason why you sell to open calls is because you think that the stock might stay flat or it might go up a little bit. And if we go back to my chart, I don't think that stock's going to go up the way it's been going down. I don't think it's going to do that. But I do think that it might go up, and it might even go up in this area. And so that's why I thought that the covered call strategy was at the time was a good strategy, and it worked out for me. Now, I want to point something out here, okay? Now, when I first bought the 200 shares of steel and I sold to open these, okay, look right here on the 13th. That's 9 days later, okay? I bought to close those $13.50 call options at $69 a contract, spent $146.48. That includes commission, and then I sold to open 2 more calls at $103. So I spend $146.48, and then I sell to open 2 more, and I take in $204.47. That's known as rolling out. When you buy to close call option, and then you sell to open new call options, either at a longer expiration date or at a different strike price, or both, that's known as rolling out your calls. And if I would have, let's say, sold to open the 14s, then that would be rolling up, but I didn't. I just did the same one because I wanted to be safe. And so that made me an extra 204 minus 46. That made me an extra, what, $58. Okay, and so I was able to include that in my original trade. And so again, if we take all of this transaction and we go back to where I finally got out of the trade, which would have been on the 26th, and we add up all those numbers, that's how I made the total 182. Okay, now if I wouldn't have done that and I would have just got out on the 13th, I guess it was, then I would not have made 182. I would have made the 182 minus 58. I would have made $134, and that's still okay. Okay, but I was able to make a little more money, and then steel went up high enough that I felt that it would not have been a good idea for me to roll it out again, because when and let's go to the option chain here. When I look at steel right now is at the price, come on, you slow computer. Come on, you slow computer, you can do it. Where are you? I would really like to go to the option chain here. It's funny, I spend all this money on a computer, waiting and waiting and waiting. Let's try this one more time. I apologize about this delay, but it is seem to be taking its time here. Okay, well, anyways, I'll just talk about it right now since the computer doesn't seem to be loading right now at this time. Okay, here we are. All right, now let me look at the option chain here. Let's go to the option chain and let's look at those $13.50 calls. Okay, so if let's say that I had a $13.50 call and I had these ones that expired in 2 days. Okay, the bid is 117, the ask is 120. Now if I were to go out 2 weeks, then the bid is 132, the ask is 137. So let's say 118 for these, and let's say 134 for those. So that would be about $18. And Ameritrade charges $6.99 commission, about $7 commission. So I would make about 18 minus 7, I would make 11. I would make another $22 in 2 weeks, and that's a very low return for the risk that I take. Now the risk, again, is the money that I'm spending on the shares, and so I got 200 shares times $13.50. That's what, $2,700 at risk. So if steel did go back down to $12 or $11, then yeah, I could make that money, but I would be down in the shares, and so I didn't feel it was worth it. And so that's why I decided just to get out of the trade and take the profit. And so that's what I did. And so the smoke is cleared, and my profit is $182.95. And now, for your information, I have a new trade. And I'll close the video out, and I'll show you the new trade. I have 2 more contracts. I bought to open 2 and we might as well just go to the transactions and look at the transaction instead of explaining it on the account itself. So let's go back to June, and let's go back to actually, let's just keep it like that. And we'll just go to the end of the transaction. So when I got out of the trade here, I sold my stock and I bought to close my calls. I have a brand new position. I bought to open 2 $15 calls at $3.92 for a total investment of $792.48. And then I sold to open 2 $15.50 calls, which expire on July the 19th. And today's July the 1st, that's another 16 days from now, and that's on the 26th that I did that, so that would have been about a 3-week time period, and I took in $102. That is a diagonal spread, okay? Now, I got burned once doing a diagonal spread on Microsoft, okay? But I learned my lesson, and I got plans in place. If steel is to make a big move up to like $15, $16, $17, I'm not just going to try to roll it up like it's a covered call. I'm going to do a ratio spread. And so this is a brand new position that I got. And of course, I'm excited about this position. And so far, it's going well for me. And right now, if we look at these calls, these 1550 calls, which were $52, if we look at the account and we see what those calls are worth right now, there you go right there. The $15 calls are worth the bid 20, the ask 21. So I've already made $60 on those. But I'm just going to hold. I still have my 6 puts, and I still have my original 200 shares, which I bought at $20.66. So I'm not worried if steel does keep going down, because I drastically lowered my risk by unloading my 200 shares from my covered call and buying calls. And so now I'm not so worried if steel goes down like I would have been before. And if steel goes up, well, I got that extra $182 of profit that I made in this video on those covered calls, and I got these 2 calls, and I got these 200 shares. And the delta on these puts, and this will be the last thing I say as I wrap up this video, let's look up the delta. These are $10 puts, and so let's go ahead and go to the option chain, and let's look at the delta on the puts here. And so $10 puts, and let's go to the option chain, and let's go to Greek and view the chain. And now we go to put like that, and then go to 2021, and then let's look at delta right there. And the delta right now is 17, but I have 6 of them. So 17 times 6, let's see, 20 times 6 is 120. 120 minus 18. So I got about a 100 delta right now as we speak, and that delta will go up if steel does drop down to 13, 12, 11, or God forbid it goes down to $10. It will go up, right? So I'm not worried if steel drops. And the reason why I bought those 2 calls is because I'm kind of neutral on steel at the moment. I think steel is going to go back to its ranging motion, okay? I mean, it was pretty unbelievable when I saw steel go down. I mean, I bought steel back in February when it was, and I have to go out to the 6-month chart. I bought steel at like right up here, okay? And if we go to the really long-term chart, let's say we go a year out, steel's been kind of ranging. You know, if we go to like a 5-year chart even, I mean, it's a nasty looking chart, and it's a nasty looking range, but it's been ranging. And so when I bought it, it was unbelievable that it dropped as much as it did, but it is what it is, and it did what it did. But now I just kind of feel that steel is going to go back to its ranging motion, and so I feel totally comfortable doing a diagonal spread. And diagonal spreads are a mostly neutral strategy. You get the best rate of return when the underlying value of the stock stays pretty near the strike price of the calls, and that's, or the puts if you're doing a put spread. So that's what I want to say about diagonal spreads is you get the best results when it stays neutral. So that's what I got going on now. I still own my original 200 shares right here, and I own my 6 puts, which is my convoluted option collar, but now I got a new position going on. It's like a trade layered underneath this trade, and I bought to open these 2 calls, and I sold to open these 2 calls. So these calls are leaps. They expires in 2021s, and these are short term, expire on the 19th, and that is a diagonal spread. So we'll see how it goes, and hopefully we can keep the ball rolling, and I can see my money grow up to $1 million. So you know, let's all hope for the best, right? So thank you for watching this video. As always, if you have any questions, comments, always appreciate support. It's very much appreciated, and as you know, I do answer any comments or feedback. So thanks again, and happy trading to you all, and I will see you in the next video.